Awesome. Let's kick off. I want to welcome all of you to Stride's inaugural virtual office hours. And virtual office hours for us is the place where we're bringing experts to you that will help you move your business forward faster. My name is Russell Benaroya, and I am a partner at Stride. And Stride is in the business of helping owners achieve financial freedom. And I'll explain how we do that, but we believe it's our responsibility. In fact, we have a mandate to bring topics to you that will help you do that. Now, we think we're this amazing outsourced back office, bookkeeping, accounting, and HR services business, but listen, we know that's only part of what helping you move your business forward faster means. So we're here today because we put out a survey last month to a couple of hundred people, business owners, and we received this overwhelming response from them that they wanted to hear about the impact of Trump tax reform on their business this year and on their bottom line. And so we went to one of our partners at Stride and found what we believe is one of the most innovative CPAs and tax accounting firms in the country called Why Blue. And Scott Hoppe and his colleague Liz Estrada are on today to help deliver to us some guidance and information and answer questions that are probably on all of our mind on how do we maximize this change in tax code to benefit our businesses. Scott is an absolute pro, totally knows this stuff, and I'm just thrilled to be able to bring him here on this call. And I want to thank all of you for making the time to be a part of it. So really excited. So just a couple of housekeeping things. If you're not asking questions, go ahead and mute your phone. And if for whatever reason you don't want to ask your question, again, this is office hours. This isn't like a webinar, so you guys can like pop in and ask questions that are relevant to you. But if you don't feel like asking the question and would rather just put it in chat, you can put it in chat and we'll answer your questions there. So unless anybody has anything else, I wanted to pass it over to Scott and we'll get started. Sound good, everybody?
Sounds good.
Okay, let's rock and roll. Scott, take it away.
Great. So I'm going to share my screen. Like Russell said, you can mute yourselves. Unmute if you want to ask a question. Feel free to jump in. You won't hurt my feelings or hurt my flow. But the target for this is 20 minutes. The more questions you ask, the longer this will go. But we'll still have time for Q&A afterwards. Let me share my screen and we'll get rolling. Just one person can tell me, can you see it?
Thumbs up if you can see Scott's screen.
Yes, I can see it.
Okay.
Perfect. All right, so we're going to look at the Trump tax law today, which Russell, queued us up for. But more specifically, besides just looking at the Trump's tax law, I want to take a look at what does it mean for service businesses. There's this new 20% deduction. That's a huge benefit, but we have to do some things to manage ourselves to make sure we get it. And I also am going to take a look at entity selection and kind of take a narrow view to see, should I be an S Corp, a C Corp, an LLC, or stay as a sole proprietor. So let's jump in, and the first thing we're going to do is look at Why Blue and the map for our team. So the blue dots represent our team members and where they are around the U.S. But beyond the team being where they are, our primary clientele focus is in the San Francisco Bay Area. It doesn't mean all of our clients are there, but it is our main hub and it's our headquarters. And again, I'm Scott Hoppe, and I have my master's in taxation. My doctorate's in accounting. I started my career off at PwC in San Francisco. Then I went to a global architecture firm in San Francisco, and then we kicked off and created the firm Why Blue. Since the firm started, I've been awarded 40 under 40 a couple times, and the firm's been featured in California CPA magazine as one of the innovator firms for being all digital, all remote, and completely distributed. What that means for you is we work with all of our clients through video, chat, email, phone, and all of our system and processes are meant to be very easy to use, and they're all digital. No more dropping things off at the office, or in the Bay Area specifically, you don't have to spend an hour trying to commute in just to say hi. Personally, for me, I love blending the tech side to the practice management and accounting, so that way we can really deliver that stellar customer experience for you. So let's go ahead and move on though and look at Mr. Trump and the Trump tax law. The law as it is was introduced by House GOPs on November 2nd of 2017. And not that far after, Trump signed the Tax Cuts and Jobs Act in December, the 22nd of 2017. And the main driver for the law was Trump promised lower corporate tax rates. Along with that promise, though, came several things. We saw changes on the business side of taxes. We saw changes in the individual's tax rates and tax structure. But probably the biggest changes, which is going to be outside the scope of this presentation, was on the international piece. So what we're going to do is take a look at a very high level of some of the movements on the business side and the individual side. So when I'm talking about businesses here, we're looking at C corporations for the tax rates, but then some of the other items like number 2 and number 3 apply to businesses altogether. So Trump promised lower tax rates, and we got them. Corporate tax rates went from 35% down all the way to 21%. They wanted to go as a little bit lower than that, but conceded, and we ended up in a much more competitive landscape internationally with a flat rate of 21% on corporate earnings. Section 179, that is your accelerated depreciation. We got a very nice benefit. We can now do up to $1 million of accelerated depreciation using Section 179. That's double what it used to be at 500,000. And then also on bonus depreciation. Again, bonus depreciation accelerates how fast you can take expenses for asset purchases. We got a big win there. We can now use it on used property. So what was interesting in the old law versus the new law on bonus depreciation is you would have, let's say, a new restaurant opening up, and the restaurant needs to buy equipment. Well, it tends to be more cost effective for the restaurant to buy secondhand equipment from another restaurant that's gone out of business. So in the old law, what would end up happening is a restaurant owner would show up to us and say, hey, you know, I bought $100,000 of equipment. It's new to me, and I'm expecting to get a deduction. I want to be able to write it off. And then come tax time, they bought the stuff, and I go, you know, it's new to you, but it's actually used property, and because it's used property, we can't depreciate it all in the first year. So you've just spent $100,000, but you're not going to get a deduction for $100,000. You're only going to get $20,000 of a deduction, and you're going to have to wait to deduct the rest of it. So that hurts cash flow, and you know, that's gone. That's not an issue anymore. Kind of a nice deal. On the individual side, we again saw lower rates. The top tax rate has been reduced from 39.6%, and now it's 37%. But we got a win there, and then we start looking at our deductions, and we got another win. Standard deductions, they basically doubled. Now it's $12,000 a person. You're married, you get $24,000 right off the bat. But with that win came a loss, and itemized deductions kind of took a little bit of a beating. And they took a beating primarily for high income tax states. Think California, think New York, Jersey, the Northeast. And there's a state and local tax limit now of $10,000. You've probably been hearing that quite a bit because it made a splash, and some states were trying to pass laws to circumvent that. They weren't successful. But what it really means is, for our California taxpayers, it's pretty easy to have a $65,000 deduction on taxes paid to the state, but now, instead of getting a $65,000 deduction for your payroll taxes, you're only going to get a $10,000 deduction. You just lost $55,000 of deductions. And another item for some of these, another limit that kind of hurts on the itemized side is the mortgage limitation. It's down to $750,000. And in California, in the Bay Area specifically, very easy to have a mortgage over $750,000. It may mean that you're not going to get to write off all the interest that you're paying. So we got to win lower tax rates. We got to win higher standard deduction, but we had some losses too, and they're material losses. So even though the rates have gone down, your overall tax bill may go up in these scenarios because you've lost so much in the way of deductions.
But Scott, if I live in a state that doesn't have state income tax, am I not penalized because of this itemized deduction change?
Yeah. In those states, I think your Florida's, Tennessee, Washington. Yeah, you're not penalized for sure. Okay. You probably have property taxes, and that's going to take up to $10,000 if you're still a homeowner. But yeah, the standard deduction, you may just not itemize, so your standard deduction may take care of you.
I see.
So if I'm that person, what I want to think about is, if I'm charitable as well, how do I make sure that I'm giving and receiving the best benefit?
Good point.
If you don't exceed the standard deduction, well, how much do you really need to give before you get a dollar benefit? Now, that's kind of being cold and saying the only reason you're giving is for the tax deduction. But it's not. The answer is not. And what we're actually seeing with this is, no, we're going to give still because we want to give, but we're going to do it smarter. And a strategy around that, since you brought it up, is bunching deductions. What that looks like is, and this is something I'm doing personally, instead of every year on looking at November Giving Tuesday, and instead of donating every year on Giving Tuesday, what I'm going to do instead is donate on January 1st and December 31st of the same year, and then skip the next year. That way, instead of spreading my charitable contributions over 2 years, I'm going to put them all in the same year and get the most benefit for it, and maximize my deductions. Well, let's move down to, let's look at number 3, AMT. AMT, the alternative minimum tax, it was on the chopping block. We almost got rid of it for individuals. We got rid of it for businesses. AMT is a huge problem, and again, in like California, it's a big issue. There's a lot of exposure there. Now, though, the thresholds have dramatically gone up. It's $500,000 for single, $1 million for married filing jointly, and so the thresholds have gone up, which is a positive. And And one of the reasons we get into AMT is we have a lot of deductions for our income. But our major deduction that caused us to be in AMT in California was paying state income tax. And now we have that SALT limitation of 10,000 in combination with the AMT limits, the thresholds jumping up. There's a lot less exposure and a lot less risk to being hit with AMT.
Mm-hmm.
But where I really want to focus our attention on for the remainder of this this talk, and really I think it's where all of our focus should be as business owners, is on Section 199A. That deduction. That's it's also known as the QBI deduction, qualified business income. And that's the 20% free write-off that we get off of our flow-through business income. So that's income coming from a sole proprietor, a single member LLC, a partnership, or an S corp. Now, we're getting this big deduction, but what really triggered the inclusion of this was to even the playing field out with the corporate tax rate dropping down to 21%. So we get to benefit from that.
Mm-hmm.
But there's some things to consider. The 20% deduction, we get it up until you make $315,000 as a service business. That's if you're married filing jointly. You get the 20% if your income is up to $157,500 if you're single, married filing jointly, head of household, basically anything other than married filing jointly. So this 315, why is it a big number here? It's because it represents the number that we want to keep our income at and below to get the most benefit from the new tax law. There's a tax trap built in to this, and it happens at $315,000 up to $415,000. That's a phase out zone. As long as when you're inside of that trap, that tax trap, what I call it, you're going to start losing that 20% deduction, which means it's costing you a heck of a lot more money, dollar for dollar, to bring home income over this limit when you're a service business. Why do I keep saying when you're a service business? And who is a service business? This threshold and this dollar amount, it matters if you're what we call specified service businesses. That's like an accountant, me. It could be an attorney, it could be a doctor. One of the main ones that's excluded specifically is architects. So if you're not a service business, let's say you make widgets, or even better, you build custom furniture, and as you're building furniture, you're set up as an S corp, so you get your flow through. You get this 20% deduction, and you make $1 million every single year. You're going to get a free $200,000 deduction for doing nothing more than what you've been doing already. Become a service business, make $1 million. You're probably not getting this. You're not getting this 20% deduction anymore.
So that's a 20% deduction on my personal returns, because in that case I have a flow through entity, right?
Yeah, and what I think will really bring this to light, and what we'll do is go through a few examples.
Yeah, good.
What I'm going to show you in these examples is if you're an individual, you're sole proprietor or a single member LLC, what's the tax impact of being over and under this? Yeah. Then we're going to take a look at how can we manage it so we can keep ourselves where we want to be, and finally we'll get to some entity selection. Let's meet Joey. Joey's a software engineer. He's married. 51 years old, and a California resident. His business is formed as a LLC, and he's the sole owner. In 2018, he made $375,000, had expenses of $75,000, and that has him reporting income of $300,000. That $300,000 is underneath the $315,000 that we were talking about. So he's going to get the full 20% deduction on $300,000, which means he's going to get the $60,000 of a QBI deduction. His total tax on earning $300,000 is $90,000, just about 30%.
And
now,
Scott, the reason
sure.
it's 90,000, that the way you got to that 30.2% is a function of what?
Good question. So the 90,000 represents 36,000 paid to the IRS, another 33,000 paid for self-employment taxes.
Yeah.
19,000 paid to California, and then another 1,700 for LLC fees.
Got
and
it.
that's a California specific thing, but we do see LLC fees of varying amounts in each state. California has a higher threshold than most, with a minimum payment of $800. But let's go ahead and let's take this Joey example and let's tweak it, and let's put him up and over the threshold. So the same facts, but now he's making $700,000. He has $139,000 of expenses, so his net income is $561,000. He no longer gets any of the QBI deduction, and now his total tax is nearly $215,000. That's 38% blended rate. What we're going to see now is he's paying $133,000 to the IRS, and he's paying nearly $45,000 to California in that mix. Everything else is going to be self-employment and the LLC fees. So there's a material pretty big jump here. But how I look at it when we're looking at the tax trap, the 315 to 415 zone, is either we want to be under 315 or we want to blow 415 out of the water to make it worth our time. 700,000, getting that income of 561, not a bad position. You know, at least he's pretty well over the phase out. I would say this is worth his time, but your tax exposure is pretty high here.
Wow, so this phases out at 415, so at 561 it's zero.
Exactly. So now we're at zero, but not all's lost, because we go, what can we do?
Yeah.
Well, what I look at with my clients and what we're talking about right now, this is the right now conversation. This is not January 1st.
Yeah.
We're talking about managing your brackets. That's managing your tax brackets by looking at equipment we need to get. Let me, you just give me 1 second and we'll be back in.
We wouldn't mind checking your email. I was curious.
Yeah, no, that's what I was thinking.
Okay.
We'll be back live though. Well, if there's a question as we go along, we're almost to the good stuff. I'm sure you can feel it.
I can. The crescendo.
All right, everything good. All right, so we're back. So I'm not my tax planning does not look at buying equipment just to buy equipment. I'm not one to say, hey, spend money to reduce your taxes. But if you need to get it, we can think about when you're going to get it. And then you look at, well, we also have a couple big tools for ourselves here, especially in Joey's scenario. We have defined contribution plans like your 401ks or your SEP IRAs. And we can manage your brackets through defined benefit plans or pension plans. There's some huge deductions that we can get there. besides managing the brackets, we can also play the brackets. And we're not in March Madness yet, but we're close enough. Play the brackets, hire family. Let's say pay your kids $12,000 to sort some files. That $12,000, tax-free to them, because the standard deduction is $12,000.
Mm-hmm.
So where you're going to pay $6,000 in taxes on that 12, after you consider everything, your kid's going to pay zero.
Mm-hmm.
That when we look at your family holistically and the taxes overall, your family effective tax rate is going to drop if you can play the brackets this way and shift income from you, high taxes, to other family members, low taxes. And then entity selection. Should we be an S Corp? Should we be a C Corp? Where's that fit in? So let's go back to Joey. And this time we're going to manage the tax brackets with Joey. So same facts as before. Joey's making $700,000. He's got the same business expenses of $139,000. Except now, Joey's managing his expenses through a 401k and defined benefit plan contributions. He has contributions of $261,000, reducing his net income back to the $300,000. In that $261,000, $200,000 of it defined benefits, $61,000 we're sending to the 401k.
Mm-hmm.
So he's now going to get the $60,000 QBI again, and his tax is back down to the $90,000. So what we did here is we just took $261,000, put it right back into Joey's pockets, and we avoided having that money be subject to a nearly 50% tax bracket, which would have costed him $124,000.
Scott, can I ask you a question on the 261?
Sure.
Aren't there limitations in terms of max percentages that you can take on those deductions?
There are limits to the max contributions for defined benefits. It's like a little higher than 200,000. And then there is a limit of 55,000 to 401k, plus a catch-up contribution if you're over 50 of 6,000. But the things you really want to consider with this and being able to play this game on contributions is, if you have employees, we want to see if we can discriminate against them, or if we can't, because it could get very expensive to max out these contributions, and you have to be fair to other employees. For you to get $261,000 put away, you may have to put some money in their pockets.
But if you're the only employee,
mm-hmm.
Is this like a SEP IRA, or are you saying it's a defined benefit program?
It's both. I'm talking. We're going to do a combination. We're going to have a defined contribution plan, the 401k, and then a defined benefits plan, which is a pension plan setup.
Because I thought there was a limitation of 50% of your salary that you couldn't exceed that.
Oh, yeah. We would have to play into the limitations what your contributions could be. So yeah, but
you have a $400,000 salary in this case, right?
Exactly, but if we look at 700,000 minus the 139, he still has 561,000 of income before we get into the contributions. So those limitations, we should be fine on those limitations. But this becomes more of an issue when we look at like being an S Corp and you want to do defined benefit plans, but at the same time you want your salary to be like $40,000.
Okay, that's my situation. That's why I'm being thrown off.
Got it. Yeah, so we have a few examples a bit later on, but you're right that there's a downside, but usually the net benefit is worth it. In terms of to reach the defined benefits plan, the maximum rate, you have to increase your payroll, which means you have to increase your payroll taxes. But you normally make the call on, well, what's that right dollar amount with us, and it's a cash flow thing. Another
Well, and also
downside, like
shifting cash flow into, locking it up in a retirement account versus not.
yeah, exactly, and you can really run into an issue too. Like with these defined benefit plans, you have to commit to it for several years. You can't just do it 1 year and walk away and be like, no, we're done. So
Okay.
it tends to work out better a little bit later on when cash flows set. But huge savings out there, huge savings. Let's take a look. Same example, but here's the numbers broken out. Gross income of 700, expenses 139. Then we get into bold, our defined benefits and our 401k contributions. That brings us back down to the net income of 300. Then we get our QBI again of 60. Something to know with this, these are high level figures, and they're rounded, and it's also on the QBI side of things, it's tentative. There are some other limitations to consider, but it adds a lot of complexity to the examples.
And Scott, just so I'm clear, that 90,604 was calculated off of 240,000, the 300,000 minus the 60,000 QBI.
Yeah. So when I'm giving you your effective tax rate, it's
Yeah.
looking at your net income of 300.
I understand. Yeah.
Yeah, effective rate's 30% is off to the 300, but the tax is actually coming off the 240.
Understood.
Or 240.
Yeah. Okay.
Okay, so then, what becomes like the next thing we start thinking about is what entity should I be? Am I the right one? Should I be a different one? And if you're already the right entity, am I doing it right? Is kind of the question. So entity selection is the question of should I move from like a sole proprietor to an S corp? And entity management is looking at, are we taking the expenses in the most efficient way possible in the entity that we are? So in our case, that would be I'm an S corp. Let's say we're Joey in that last example. I've made $300,000. If Joey's paying himself a salary of $300,000, probably I would call that mismanagement, entity mismanagement, because reasonable compensation is not likely that $300,000, and what he's doing is causing himself to pay way more in taxes than he should. So keep that in mind when we're thinking selection and management. And what we're going to do now is we're going to take the Joey example and we're going to run through him as he was as a single member LLC, which gets you very similar figures as if he was a sole proprietor. And then we're going to look at him as an S corp and look at it as a C corp. And let's see, let's kind of find out what's going to happen under the new tax law. All right, so here's Joey as we've known him. Back to the beginning example. 375,000 gross income, 75,000 of expenses. Side note to those expenses, that's a 20% expense ratio, which for software engineers and service businesses, really efficiently run ones are somewhere between that 10 to 30%. 30% is pretty high. So we went with 20% to keep it right in the middle. And then on this example, we're back to our 90,000 as a single member LLC. Okay. Slightly less if we were just a Schedule C, because we wouldn't have to worry about the California LLC fees. Let's take a look. Same example. Now Joey's an S corp. We're going to pay Joey $150,000 as owner's payroll, and then we're going to take the other $150,000 as a distribution. It reduces his QBI, but we dropped his taxes. We just went from $90,000 to $82,000. $8,000 savings by making a minor switch to an S corp and maxing his payroll out at 150. What I care about when we're looking at entity selection is how much does it cost for me to get to my assets? And the assets for us are typically cash.
But is that owner payroll a gross number, and does that owner payroll have taxes associated with it?
It does. It does. So we have taxes associated with it. When we look at this net amount, I'm still including the payroll taxes.
Oh, okay.
But now the payroll taxes are for $150,000, not for $300,000.
Okay.
As an S corp in California, we're subject to another tax. California loves to tax us. 1.5% of net income gets taxed if you're an S corp.
Mm-hmm.
That's a little different than the IRS, who disregards the S corp altogether and just taxes everything on your individual 1040. But think about this S corp example and take the $8,000 savings. Talk about 5 years from now, you've saved $40,000. Even 1 year of the $8,000 savings, and that's assuming you're never going to make any more money. And this assumes we're never going to do any other planning. You've more than paid for my fees. Not a bad deal.
Mm-hmm.
All right. But you go, Scott, the Trump tax law, we looked at it a little bit earlier. I saw that corporate tax rate drop down to 21%. Should I be a C corp?
Right. Do we go there?
Do we go there? The answer is always going to be it depends. But let's look at Joey and let's keep everything the same. We're just going to change structure.
Yeah.
Now we're a C corp. We're still going to take $150,000 of payroll, and we're going to take the other $150,000 as a dividend, not a distribution, but a dividend. In this case, our taxes have gone up quite a bit. So we're going to have taxes to Joey on his 1040. We're going to have payroll taxes. We're going to have California individual taxes. Then we're going to have C corp taxes with the IRS of 21%, and then we're going to have C corp taxes with California of just under 9%. And when we look at that dividend distribution, that $150,000, that's double taxed. That means the corporation's been taxed by both the IRS and California. Then Joey's being taxed on his personal return for this income again, resulting in a 40% tax rate versus the S corp of near 27%. So when we look at them side by side, lowest to highest, we got in Joey's scenario, we got the nicest answer as an S corp. Single member LLC, slightly worse off, and a C corp is the most punitive, even with the reduction in the corporate rate. That is not always the case, and if we were looking and we wanted the C corp structure because there's maybe a benefit in the deductions we can take there, employee fringe benefits, then I likely wouldn't have the pay structure be 50-50. I wouldn't, and probably not even with the S corp either. I wouldn't pay him $150,000 then take the other 150 as a distribution. There's likely a more optimal ratio on the C corp side, and typically for C corps that is a higher salary.
And Scott, is there an optimal ratio on the S corp side? I know you divided it equally, 150 and 150.
Yeah, I did divide it equally, and that is not what I would do when we're looking at clients and reasonable compensation.
Okay.
So, I mean, how many people have questions on reasonable compensation for S corps? Because I think that's an interesting topic.
I do. Is there a rough benchmark as to what percentage is kind of starts to begin attracting attention?
Yeah, there is. So there's about 9 tests that we can do to sort out reasonable compensation. When we work with clients on calculating that figure, there's 3 that we really narrow in on, and not just one of them answers the question if it's reasonable compensation, but looking at all 3 does. So one of the tests is I look for a ratio of distributions to salary of 54% to 46%. I just told you that. So, for simplicity in our example, I did 50-50. In reality, I would never do that. We would do a 54-46%. But that's only one number. The next one that I would look at is fair market value. That takes market research. What's the job? Do we want to argue you lower? Let's say reasonable salary is 100,000, but we really want to get you closer to 60,000. Well, I would say, hey, let's look at your schedule. Do you work a full schedule, or do you work a little less hours than normal? Maybe we can argue it down that way. So there's a fair market value component. And then the last one that I use is looking at all your payroll of all your staff. Are you being paid more than the next highest compensated person? And it's not to say that we don't have a one-off where an employee gets paid more than you, but oftentimes the most valuable person in the business is you, the owner, and you're putting your time in. That I want to compare what we're going to say your salary is and make sure it's not radically underneath the next highest paid employee without due cause. If we have a reason we can support it, no problem. So when we look at those 3 factors together, what we tend to do is take them all the answer to each one of them, and then we'll say, okay, look at the 54-46 split. It says I should have a salary of 250,000, but reasonable like a fair market value for my salary is actually 100,000. Well, now I'm going to disregard the 250. I'm going to look at fair market value instead. And then from fair market value, I'm going to compare that to your next highest paid employee to make sure we can either we're above them or we can substantiate why we're below them. And by doing that, I can go through a very reasonable test and document exactly what your salary should be, so we don't cause flags or issues. Mm-hmm. In my example there, the 54-46 gave you a salary of 250. What happens if it gave you a salary of not 250, but only 50,000? Well, if I have a salary of 50,000 from that analysis and my fair market value is 100, now I can start relying on the 54-46 split to make my salary not fair market value of 100, but actually 50. And that means I pay way less in payroll taxes. But I can do that because I'm not overpaying myself in distributions. I'm paying myself an appropriate and reasonable salary and taking the remainder as distributions. So there's 9 tests. I focus on 3, and that's something that number moves for every company, every industry. But I would say if I was not an S corp, if I was a single member LLC, disregard it, a disregarded tax entity, or if I was a sole proprietor, if I'm making net income of 150,000, really over 100,000, I want to start having the conversation about entity.
Excellent.
Am I the right entity?
Yeah.
That's my line. So what do I want you to know from this? I want you to know if you're a service business. I want to know if you're the best entity you should be. And I want you to know to manage that $315,000 limit. If you can work on those 3 things, you're going to come out of the tax law changes as a service business far, far ahead of where you were in prior years. But you may also just want to look at some of the overviews of the tax law changes for individuals and see an overview for businesses. I have a couple of those on our blog, and there's the tiny URL right there for you. I can also include those in our chat on Zoom or send a follow-up. But I really thank you for hanging in there with me. We talked about some hard stuff, and I really hope these examples resonated with you.
Yeah, they were great. Yeah, questions, office hours.
I have a question on 179.
Yeah.
So there's always a lot of talk about the accelerated depreciation, but I've never, in my experience, heard anybody talk about what I assume are the gains on the back end at the time of sale.
Yeah.
What's the thought on the trade-off of that? Why is it so desirable if you're just accelerating your gain on sale?
You do accelerate the gain on the sale, but it assumes that you're not holding the asset long term, and you're churning assets, which may or may not be the case. Kind of a funny story that I heard out of South Dakota was this. It was a farmer, and he had $500,000 of tractors, and he took pretty kind to a new farmer that was young and starting out, and the kid was working for him for a bit, and the guy finally just said, you know what, I'll sell them to you for basically nothing. But he thought, well, no problem, and he went to his CPA, and he actually triggered a $200,000 tax bill, and it's because he took 179 on the tractors, gave them away, but then he ended up having business and gifting tax issues. So that he got burnt. He had to pay a lot of money for being kind. That doesn't necessarily answer your question, but it shows you that you can have a pretty high exposure on an asset that's not going to decrease in value.
Well, can we take just a simple example that's California relevant? Let's just say you go out and buy a $100,000 Range Rover. You deduct, call it 50% of it year one, and after like 3 years, you've deducted almost all of it or whatever the case may be, and then you sell it for, call it 60. Then don't you have taxes on roughly 60K in 3 years? Or are you saying if you buy another, 6,000 pound vehicle that you don't have a gain?
Yeah, you don't get. So there, yeah, you would have a tax event on the sale of the 60, and that, yeah, you would look at your adjusted basis, whatever that may be at the time, following the electric auto rates, which it actually bumped up a little bit with the law changes too, so that's nice. But yeah, you would have a tax event there. Then you'd go out and get a new car and potentially start the process over again if that's what you're doing. Or you hold it and you give the car to your kid or something else.
Okay. I mean, obviously the benefit that you're getting up front is still better. It's just I never hear anybody talking about the back end. I was just curious.
Yeah, we tend to manage the back end when it's arising when we're thinking about a sale. But like in the car example, which is a good one, or with a lot of the assets, the value drops dramatically. And Section 179 is taking on new assets. By the time we get to the used market, it's we're not normally seeing appreciation. Not always.
Okay. Thank you.
Hey, Scott, I've got a question in regards to real estate limited partnership interest.
Oh, yeah. I'm gonna try my best on that one. I saw your question come through earlier, and I was like, that is specific. What do you got?
So, the question is, for those that invest in real estate limited partnerships, and say it's generating income, can you get 20% of that income?
The answer
is
it depends.
income. Okay.
What's it depend on? It depends on if it's an active investment and if you're considered a real estate professional. Thresholds are the same as it's been. The same hour test exists, 750 hours, and over 50% of your time needs to be spent there. So if you have a day job, you're probably not a professional. if the K1's showing up to you and it's marked as passive, probably not going to get that 20% deduction. But if you think you are professional, the IRS is expecting lots of people to say that because that 20%, it's a pretty big deal. And real estate investors, the professionals, it's not considered a specified service business, which means I don't care about that 315 limit. You could get 20% on a big number. What's interesting about that, kind of that rule around being a professional versus passive and getting the deduction or not. Think about Donald Trump. He's got a new day job. It's going to be really hard for him to prove that he's a real estate professional now and be able to write off as many losses as he can. Instead, those losses are going to be passive. And when they become passive, it's limited on what he can take each year. So it's gonna cost him millions of dollars to be a president for the next few years.
So let's take another real estate example where I own a single family home that I'm renting out, and I'm managing it and I'm dealing with it. No property manager, et cetera. And it's generating, say, $10,000 net. What are your thoughts on getting 20% on that?
We're back to our real estate professional threshold. So what we would be looking at there is, if you have a full-time job, it's a very hard threshold to fight. You need to document your time and your hours really well to support it, because we're expecting the IRS to take lots of people into audits, potentially to court. And the only thing that's going to help us prove our case is a log of time spent. If you're retired, it may be an easier threshold, because now you just need to do 750 hours. Kind of hard. That's kind of a hard threshold, though, if you just have a single family home. And then we also look at, if you're a full-time employee, you're spending 2,000 hours at a job. How can we ever say that you're spending 2,001 hours extra on real estate? Probably aren't. It's gonna be really hard to say that you're doing 80 hours a week or 81 hours a week, and 41 of them are on real estate, and 40% on my regular job. All hope's not lost, though. You could reduce your hours. You could keep logs. You could time it. But I'd make sure that I'm making a hell of a lot more money than $10,000 net on that, because that's only going to be a $2,000 deduction for 20%. Most, like California, they don't conform either. So you're not getting that 20% deduction with California. That means of the $10,000 you're netting out, you get a $2,000 deduction. When we think about real tax, oh man, I could do math, probably $600 or so of real tax saved. I'd rather have my full-time job.
All right,
Something
thanks for your opinion.
Yeah, no problem.
Scott, I have a question for you. We have a number of clients that are on accrual-based accounting. We have a number of clients that are on cash-based accounting. Does accrual versus cash-based accounting have an impact, and should it change how our clients think about their method of accounting? I'm curious.
Yeah. That's a good question. And a good change with the tax law was cash-based businesses that were holding inventory. Before, there was a $5 million, we were looking at about $5 million of gross receipts. And at that point, we had to make a switch from cash. And we had to hold, even if we were cash basis, we had to hold our inventory in accrual. Most businesses under $5,000 or $5 million in gross receipts, they may not have the complexity, the staff or the team to even handle an accrual basis inventory and a cash basis accounting. But now that limit's 25 million. So what we're tending to see is, some people, if you're a service business, pretty much if you're under that $25 million mark and you're a service business, you probably want to be cash. you don't want to pay. If you're an attorney, you're definitely cash.
Yeah.
If you're an accountant, you're cash. You don't want accrual because you don't want to recognize income without ever receiving the money and having to pay tax on that.
Right.
So those items have stayed, that analysis stayed pretty close. We want to stay cash as a service business, and the thresholds have gone up. So we don't have to put as much thought into, oh crap, now I'm in accrual and I was cash. What's that mean for me?
Yeah, got it. Makes sense. We only have a couple minutes left. Any last questions for Scott? I'm sure he'll take your email questions after, but any last questions while we're on the call?
Yes, one question. Can you hear me?
Yes.
Okay. The question is does Scott intend to get a pitch on individual taxation, the changes in the individual and not so much on business? I saw it on his last view graph.
Yeah. I can send you out the tiny URL again for that. There's some overview items there. The individual side, I'm watching out for how do we get the best deductions for what we have now with new limitations on itemized deductions. So we have that. It's that $10,000 limit again. That's a big deal. It's a big deal in DC, a big deal in California. But kind of going beyond that, a lot of it's going to be managing your income, so that way we can make sure if we have a business and we're an individual, we're getting that 20% deduction. That's our key opportunity.
Thank you.
You're welcome.
Great.
Please, send me an email. I answer fast. I'd love to get on a video chat with you. It's pretty easy. Scott at Why Blue. And if you have any questions that you see on the blog or anything that comes to mind after this, I'm happy to talk through it and share what I can.
Yeah. And everybody that register for this call, I will send out a link to this presentation as well as Scott's information. First of all, I want to thank all of you for joining Virtual Office Hours today. I want to thank Scott for hosting. And just so you all know, next Wednesday, we're going to have David Cook on from Sovereign Legal, and he's going to be talking about the legal issues surrounding contractors versus employees. So that's a hot issue. Thank you, everyone, for being here today at Stride, and we're working to do our part to help you move your business forward faster. And Scott, we really appreciate you being generous with your time and laying some groundwork for the impact of tax reform on our bottom line. So thank you all so much, and have a great day.
You too. Thank you.
Awesome. Thanks.